have had an opportunity to go over the previous webinars. I think they're pretty good. It shows you how to identify a trend, shows you how to identify the super year. And so there's a lot of information in these webinars I try to provide. I also want to say that on 22nd, we have pretty much a full class for the mentorship. There's still a few seats. Those of you who are interested, let me know. I'll send you a syllabus, what we learn week by week. I'd love to have you join myself and the rest of the group that has signed up for the current class. It's going to be an eye-opener for those of you who want to learn price action and manipulation. And also, I've gotten a lot of emails on a few different things, so I try to bring these topics to everyone. So let me take a look here at the DayTradeToWin blog. It's the blog. It's part of the DayTradeToWin website. And there's a difference between the dynamic and Superdome if you're looking at using NinjaTrader. And there is a difference. The static Superdome, the price does not move around as the dynamic. There's a couple of other instances where the brokers only support one or the other. So I created a little bit of information here, an article on it. And those of you who have questions on the differences between the dome, you can take a look at this article here that was written recently on the DayTradeToWin blog. Another aspect is the software tab and the free downloads. I have here a few things that some of you may be interested in, like a news indicator you can download for free, or an online news calendar that you can access for free. For those of you who want the bar timer for TradeStation, if you're a TradeStation user, there's a code here you can download for free, a TradeStation a bar timer and a tick counter. And this last one here, Karen's Time Sync, is a program that I think every trader should download. It's a free program, which I have linked here, which basically makes sure that your computer clock is linked to the rest of the world. If our computer clocks are slower or off, then obviously the candles, when the candle closes or open, it's not going to be the same. So I've noticed that if your computer clock is not correct, then, for example, when I add the bar timer here, the close of this candle may be different, off by a second or two. The closing price is going to be different. So making sure that everyone is on the same page with the time and these candles closing. The Karen's Time Sync is a free program that may help that situation, okay? DayTradeToWin.com blog. Okay, DayTradeToWin.com blog, Claudio. And you can access it through DayTradeToWin.com, right? So just go here to the blog, all right? And you can take a look at the previous webinars as well that are listed here as well. So it's nice you have this information here, okay? Hey, Dan. Okay, so let me remove this here and let's talk a little bit about trading, right? So every morning before the market opens, you think about preparing yourself. You think about what's the day going to be, and all these ideas may come through your mind because obviously the guy on the TV says the economy is terrible, or somebody else, maybe your friend, says the economy is great. Maybe that guy John Paul from DayTradeToWin is telling you that it's a super year and expect only to go long. So you have all these ideas that are going through your mind, right? Hey, Roger. And you're thinking to yourself, well, what do I do? So there's a couple of things that I like to prepare each and every morning. So while we wait for the setup here for the Atlas line or any other thing that I see here to go long or go short, we have to make sure that we're understanding what's happening, the bigger picture. All right? Even as day traders, we have to look at the bigger picture. So look at a news calendar, whether it be the news indicator that I have. Let me just bring it up here. I should have it. Which is news right here. You can download it for free. Twin News right there. And it's going to provide you here on the top left-hand corner whether or not there's news that you should be concerned with and the times and the days. And so this news indicator right on your chart tells you that at 10 o'clock on April 17, there's a consumer sentiment. So if you're going to trade at 10 o'clock today on April 17th, this is a high impact, high priority news event. You don't have to use my DayTradeToWin news indicator for NinjaTrader. Use any calendar, whether it be Forex Factory. I like the Bloomberg economic calendar. And so I want you to know that these news events impact how we trade. So every morning I look at whether or not there's news that will impact whatever I happen to do. Now, the at the open method, which I teach in the mentorship, and some of you may have it from years ago, or the Atlas line, they typically give you entries about 9:45, 10 o'clock, 10:15, around that area. So when you have a setup that's occurring right as a news event is about to be released, the problem is we don't know the direction. We don't know if there's even going to be a reaction. There's a lot of unknowns that are going to happen. And therefore, if you have a stop, most traders have small stops. I'm not sure if this news event is going to make the market run up and then run back down, which in many cases is going to just stop you out. There's a lot of activity, there are gaps, there are slippage. There's a lot that can go wrong. So I recommend that within the 5 minutes that that news event is popping, where everyone is jumping in, buying at market, and the market may be chaotic, just stand aside, wait until the chaos is over, and then you can jump back in. There is a way that I trade the news, which I'm going to show you, and you've probably seen it. I have a few videos out there. This may be something new to you as well. Some of you may be new here to how I trade the news. So let's talk about that for a minute. Trading the news doesn't have to be complicated, but it does have to use a little common sense. If there's a news event that is about to be released and you have all of these traders that are going to buy or sell for no other reason except a positive number or a negative number, or better than expected or worse than expected, then you have a problem, because there's no other reason, there's no analysis. It's just, oh, unemployment was good or unemployment was bad, boom, market, buy, sell. And that's how a lot of traders enter into the news, thinking that the market's going to continue. On the other side of the coin here, many traders, right before a news event, let's say that the news event's about to come out and the market begins to be very tight like this, what's going to happen is you put a stop here, you put a stop to go short here, and these are stop entries to go long or to go short, thinking that if the market is going to break, if the news is positive, I can get long. If the news is negative, I can go short, right? Then definitely you're thinking about jumping in. But it's not that simple. It's not that simple, because as you enter long or short, what could happen is that the market comes up, fills you, and within the same candle, let's say we're looking at a 5-minute chart, in the same candle, the market comes roaring back down. And so even though you may have gotten long on this breakout, the candle itself only got you long and didn't continue, and instead turned around and maybe stopped you out, and then you go short. And there's a lot that could happen within this one chaotic candle. The market could fluctuate up and down and up and down. It's a big mess. I've seen it many times, and it's unpredictable. The other problem is slippage, because if you have a stop order to go short or go long, you would think that you would get this price, but more often than not, because the market is a zero-sum game, it's trying to reach all of the buyers and sellers and match them up. If there's 5,000 contracts trying to go long, it's going to search for 5,000 sellers to initiate that trade. So what's going to happen is you want this and you only get this price because of slippage. And again, that doesn't help, because it's not where you want it to get long, The market still has to go higher for you to be successful, and it may not go higher. So there's no real correlation with positive news with the market continuing higher and negative news with the market continuing lower. So this is all issues that if you try to trade the news, you're probably going to encounter. So on another note, let's instead not do anything. The news comes out, and instead of jumping in, following the herd like sheep, we're not going to go long or short. Instead, we're going to wait. We're going to wait until we see a candle that is chaotic, that everyone bought or sold, and that created either a long or short move. And we don't know what's going to happen, but we're just going to wait until we have the outcome. So the market reacts to whatever news event happens to be, FOMC, PPI. And another news event that occurs is Janet Yellen, the new Fed chair. It may not be listed as a high priority event in whatever economic calendar you look at, but remember, when she speaks, many traders pay attention and they hang on every word that she says, and they will react to what she is saying. And so be very careful if you're in a trade or trying to initiate an order as she is speaking, because she may say, I believe we're going to raise interest rates, or I believe that we're going to keep interest rates the same, and the market will react to those comments. The news is released, the candle is bullish. That means it's a green candle, and many traders bought thinking the market's going to go higher. And it may go higher, right? So it could continue to go higher. But think about what happens if it doesn't go higher. And if many traders got long here, right here at the high of this move or at the close of this chaotic candle, think about the reaction. If this does not continue higher, but instead begins to fall and turn around, you have many traders that are stuck. Many traders that are long, many contracts that created, right? It created this large candle, and yet it's got nowhere to go. So there's really only two options for all of these traders who went long. Well, there may be more than two options, but the main two options that they really focus on is getting stopped out and maybe hitting reverse. Both options lead to a short trade. So think about if this here does not continue higher for these traders who just blindly went long or short on the news, how are they going to react if the trade fails? And if the trade fails, then look for a huge amount of sellers or selling based off of stops or even hitting the reverse key, which will initiate a huge move to the downside. And that's where I, as a trader, look at an opportunity. Unfortunately, I'm taking advantage of everyone who was wrong on going long based off the news, and I'm taking advantage of the selling that's about to hit. I'm jumping in to go short when I see two consecutive candles closing below the green, which is a higher close and open, long, chaotic move. So the idea here is not to guess and to bracket off the news. The idea is to wait to see first. You have to know if there was a reaction. So was a reaction to the news, yes or no? And we know right away. If the candle is very large, if the candle was extremely out of whack compared to the last 4 or 5 bars, then you could say, I see a reaction to the news. It's It needs to be black or white, because the only way this move works if there was a reaction. And so if there was a reaction, you know, everybody blindly bought or sold. If the candle is green, I'm going to go short. If the candle is red, I'm going to go long. So I'm looking to do the absolute opposite. So therefore, when I look to go short, it's 2 consecutive closes below where most traders have their stop. So we'll use this red here, or maybe hot pink here. So if most traders have their stops just below this candle, as soon as this long fails and the market starts to go down, 2 candles that plot, you have your short opportunity. And this could happen anytime throughout the day. Anytime throughout the day. So if you have an Atlas line trade, or if you have a strength or pullback trade, Dejan, if you have any trade whatsoever, you can take the trade before the news, but as the news is coming out, you have to be very careful. So maybe exit, wait until the news is over. Just 5 or 10 minutes is enough. If there's no reaction, then you're fine. But if there is a reaction, wait until that large candle is cleared out, and then you can go long or short after that. So anytime throughout the day, if it could be within the last hour of the trading day, if you have 2 candles that close above or below the initial reactionary bar, you're short or you're long. Does that make sense to everyone? After the news, we can jump back in with the Atlas line, strength, or pullback. Just give it 5 or 10 minutes, Dejan. Okay? That's what I would do. As the move is occurring, you stay on the sidelines. Let the chaos pass. After the chaos passes, you can then reinitiate the trade. So for example, on the Atlas line, a double bar short at 20.8075 just triggered to go short. So this is a short trade. Now there's news coming up here at 10 o'clock, which is unpredictable, right? The news says here that at 10 o'clock, which is in about 5 minutes, you have consumer sentiment. So we don't know if the market's going to shoot up or shoot down. So if you go short, anyone who has here the Atlas line, or any method for that matter, ATO or the blueprint, any of the methods that I teach or anything that you're trading, you have to understand that when there's a reaction, this market may jump, and it has nothing to do with what you see here. It's just a blatant reaction to the news. Wait a little bit until the news has either occurred or no reaction or some reaction, and then you can say, okay, let me go short now. Pullback, strength trades, maybe still in this double bar short. There's no problem with that. All right? All right, now, if this candle, the reaction candle, happens to be the opposite, let's say that it's a short candle and everyone sold the news because it was really bad news, right? Okay, so if it's really bad news, you would assume that the market will continue lower. But if it doesn't, you have a lot of short traders who are going to get squeezed, and they're going to have to cover. And when the market reverses anytime throughout the day and closes above the high of this red bearish reaction, the long is going to be 2 closes above the high. All right, does that make sense? Hey, Jafar. So let me know if that's clear to everyone. When you look at understanding the news, it's always best to have a clear, concise method as opposed to a guess, because you never know the outcome. All right, any questions on that? Let me know if you're okay with that. Dan, Mr. Kim? Hey, Jason. Some mentorship students here in the room. Glad to see you guys. That's a great question. So Andy asks here, how big does the chaotic candle have to be? It has to be relative. So when you look at the market, you look at the market being, let's say, let me put it kind of in realistic terms here. The 4 or 5 candles that came prior to the news, okay? So let's say that you're referring to these candles here. The last 4 or 5 candles that came prior to the news. When the news is released, if you have a candle that's the same width as the last 4 or 5 bars, I can probably tell you that there's no event, there's no news, there's no reaction. Nobody really cared what the news number was, and so trading is as normal. But if you see a candle that is overwhelmingly the range, meaning including the wicks, high to low, looks like that, this is definitely larger than pretty much all the candles that came prior to it, even this big large one here at 945. So it's a instant understanding that there was a reaction. Now, it's all relative, because if the candles prior to this reactionary candle are very small, let's say they're just 1 point in range. A candle that's 2 or 3 points is a reaction because it's double or triple the size of all the candles that came prior to it. If the ATR and these candles happen to be, let's say, 4 or 5, then a reactionary candle would have to be 8 or 9 points in a range. So it is a relationship of the last 3 or 4 bars. Just look at it. If it's not clear that it's a chaotic bar, then it's not. It has to be clear. Okay? Mr. And, okay? Just one candle, Peter. It's just one candle that is the reaction. It's usually just one bar that provides all the massive buying at market or selling at market. And remember, the way that this works is there's a lot of traders that are huddling around maybe a news release service, or maybe they're looking at the news on TV, and maybe the Bloomberg or the Fox Business, whatever news outlet you're listening to, and then the speaker says, okay, the news has been released, this was the result. Then they click buy or sell. And there's a lot of different, I would say, programs that maybe give you a couple of seconds before everyone else, but realistically, it doesn't really matter. Within that 5 minutes, I'm using a 5-minute chart, within that 5 minutes, it's a huge typical reaction that occurs. And after the reaction, we can say, okay, let's go long, let's go short, but doing the opposite if and only if we have the opposite move occurring. So if this is a short, then we have here 2 candles below the low. So this is the low, 2 closes below. My proof, I'm sorry, if this is a short, I'm going long, the opposite. So 2 candles above to go long, or vice versa. If this is a green candle, I look for any time throughout the day, because they will hold this trade for hours hoping that it's going to work. Anytime, right, Mr. Kim? Anytime throughout the day. Absolutely. All right, good job, Jafar. All right. Now, I'm going to give you guys a little bit of a tip, because there is a tip that sometimes occurs, almost like a giveaway. Sometimes, and please, by all means, go back and look at when the news is released. And with this DayTradeToWin news indicator that I have, you can choose whether or not you want to see, for example, let me just go over here. You can look at just European news or United States news. And the reason why I added this is because I understand that not every trader trades the US markets. You may be trading the New Zealand dollar, or you may be trading a market that only reflects to that economy in the world. So this is universal. This method that I'm showing you about the news is universal, because you can look at a specific British pound news release, and so for example, if I click false, you're going to see all news events throughout the world, And if you see a market that you like to trade, the British pound or the euro, and there's an economic report relating solely to that market, this is exactly the same idea. The rules don't change, because if there's a reaction based on that news event that's specific to the New Zealand dollar or the Australian dollar or the British pound, whatever the case may be, you're going to see a reaction. And if the reaction does not follow through and it reverses off of the initial reaction, you have that opportunity to go long or short based off of proof, 2 candles closing above or below in a reverse. Okay, so when I click apply here, let's see what happens. And you see here that you have a couple of more news events listed. IMF meetings. They're green, they're medium, they're not red, and they have, here's the euro. President is speaking for the euro at 12 o'clock. And this indicator plots the news time in your computer clock time. So it's not 12 o'clock Eastern Standard where I am. It would be related in your chart for your local time. Okay. All right. Anyone have any questions? All right. Mr. Kim, you okay with that? Peter? Going short on the euro? I'm not sure. Maybe you could go short on the euro. But we have to do everything based off of proof. Okay. Make sure you have the settings right, Rob. I'll take a look here. Make sure that the settings are equal to mine. So let's take a look here. And if not, I'll have one of my tech guys take a look, hop on and make sure that everything is working properly. So this is what I have, and you can copy my settings, Rob, as well. Right, so there's a lot of settings here. Max News 10, show low priority. I have false. I only want to see high priority. Today's news only. I want to see all news. US news, show low priority, so we can say true, right? And so on and so on. Okay, so maybe just check the settings, okay, Rob? All right, fantastic. All right, so what do we have here on the Atlas line? You guys saw the Atlas line plot live to go short. And let me explain a little bit here on the Atlas line. Besides whether or not there's news, which we have to be careful with, and as an opportunity, look for the opposite of the news. That being said, 10 o'clock here is the news release. Can you relate a reaction that occurred this morning off of this news? If you look at this candle, this candle, this candle, is this reaction larger than any of the candles that came prior to it? No, not at all. It's actually the same. So the conclusion is that you can't look at this method that I'm showing you as an opportunity to do the opposite. Because the only way this works is if you have a massive amount of traders jumping in, and then you have the same almost massive exodus because it failed. And since we don't have a reaction, then you can't do that. All right. So really look at it as common sense. You guys okay with that? Peter, Shay, Alex, Dan, everyone else? All right, Harold. Okay. Now with the Atlas line, this is 2080.75 to go short. The purpose of this short entry, believe it or not, is price action. I'm price action focused. I look at manipulation. I don't use any type of indicators. All these indicators that you see here, all this list here, they are all late, and they all give you after the fact information. So I'm not looking for that. I'm looking for price action. I'm looking for the market to be interpreted based on the price. So what do I know about the price? What do I know about price action? Well, I know that the market is pretty volatile. If you look at this ATR, and I have plenty of videos that talk about this ATR, the average true range. I use a setting of 4. You can pretty much dictate the stops and the targets very clearly without any confusion on what's to come. If you go short at 2080.75, Preparing yourself for the day as part of this webinar is to say, is the market slow? Is the market fast? What am I going to encounter if I do take a trade long or short? Well, the expectation is that if you enter short at 20.8075, like the Atlas line gave, I can expect the market to go down 3.5 points, or even 3.5 points up against me, but the expectation is 3.5 points. Believe it or not, many traders don't think of this. They think of, I always want to take a point, or I always want to take 2 points, or 5 points, or whatever, and it's relative. The market being at 3.5 points dictates that I can expect the market to move 3.5 points. So 20.8075, 20.76 would be roughly 3.5 points down here. So you can see that the expectation was met. So every morning, look at whether the market is slow or the market is fast. And really the only way that you could dictate that is by looking and preparing by adding the ATR, the average true range, on your chart and saying to yourself, do I want to trade if the market's more volatile? Or maybe you want to stay out of the market if you have a very slow condition. All right, some questions here. Is the body size the category bar important? No, it's not. It's whether it's a green or red. If it just closed a couple of ticks higher than where it opened, it's still considered a higher close than open. So no, the body size doesn't matter. That's a very good question, by the way. The body size does not matter. It's whether or not it was green or red, to be simple, and if there was a higher high to low chaotic range compared to the last 4 or 5. So that's a good question. The body size doesn't matter. Kevin, is it too late to short now? The strength trade occurred here to go short again, Kevin. I'm not sure if you saw it, but this would be another opportunity to go short on the strength trade here. We may have more shorts as well, okay? So look for a pullback or strength trade, which the Atlas line produces. Tom, on news breakouts, then market entry and ATR for the profit target. Yes, so let's talk about a little bit of the profit target for the news. When the news, when this news method that I'm showing you actually happens, where you go long or you go short in reverse from the actual reaction, what is my profit target? Definitely look at the ATR as a guide. If the ATR is 1 point, you know that you can at least make a point out of it. If the ATR is less than a point, I would have to say, Tom, if you're looking at a 5-minute chart, that is a great determining factor that there's nobody here to trade. So just put a horizontal line here at 1 point and know whether or not it's even worth trading. So another way you can prepare yourself is to see whether or not it's even worth the 1 point to trade, because if it's trading for 3 ticks, you have a lot of whipsaw and there's nobody here. If the ATR is at 5 when you enter long or short on this news event, and I have to say, this is not just for the news trade that I'm showing you. This is for any type of trading that you do. My methods or other methods that you may be looking at. Remember that anytime the market is slow, you have a harder time making what you want to achieve. Even if it's 3 ticks or 2 ticks, you have a lot of dojis and gaps. There's nothing there. When the market is more volatile at 5 points, you have to have a larger stop to stay in the trade. My cutoff is 5 points. I think that's an extreme. 4.5, 5 points is my concession that I should not be in the market risking that much of a stop, because I have to have a larger stop than the current conditions to stay in the trade. So this is definitely a guide for the extremes to get it to stay in. Normal, 2 points, 2.5, 1.5, that's normal. Okay, Tom? So you have to look at the average true range as a profit target unless it's at that extremes. Dean, can the ATR setting be applicable to different time frames? Yes. So, hey Dean, have you seen the few videos that I have out there, the webinars that I've done where I discuss the ATR, why it's important? If not, definitely take a look at the DayTradeToWin blog or the YouTube channel. I have hundreds of videos, outlining and detailing the reasons for using the ATR. And when you look at other markets, like the euro, like the British pound, like the, for example, any stock, any ETF, doesn't matter. Use a setting of 4, and on a daily chart, on a weekly chart, on an hourly chart, on a 1-minute chart, it's exactly the same. It doesn't change because you're looking at the last 4 candles for that time frame and the expectation that it's going to continue for another 4 bars into the future in the same range, same distance. Okay. Peter, 3.5 points from where? 3.5 points for this trade from the entry. So the entry was 20.8075. The closing price, 20.8075. My mistake. It's this green bar right here. So the entry is 20.8075. The close, Peter, of the second candle. So when I say that I'm looking at the Atlas line as a guide and I'm entering using price action, and I teach this, we have a live webinar for purchasers of the Atlas line software. We have an hour and a half live training with me, which is recorded and sent to you. The rule is 1-2 consecutive closes, which dictates the long or the short below or above the Atlas line. So you see the closing price of this candle, it coincides with the entry. So there's not really a secretive entry, why 20.8075, but you should know it's because there's 2 consecutive candles closing below the Atlas line plot, or if in the future, if it crosses back up, it's 2 closes above. And the closing price of the second candle is the entry. Peter. So 20.8075 from this candle here to go short, 3.5 points. Okay, Mr. Kim says here, why is my ATR line showing several candles in front of the last candle? There's probably a displacement that you have configured, Mr. Kim, so just make sure that you have the settings like mine. If you look at the ATR setting here, period of 4, that's all you're using, and there's no displacement. Make sure that this is 0. This is probably something that you've changed, so you're displacing the ATR. Okay, so make sure that's 0. Okay, what else we have here? Kevin, you're good? If it's a doji, there's no trade. Andy, there's no trade if it's a doji. You have to wait for either another kata candle or you can't trade it because we don't know what the reaction is if it's a doji. Kevin, I'm looking for the most recent activity. That's the reason why I use a 4, setting a 4 in my testing. And remember, I've been using this setting of 4 for years now. And if you look at 100 candles, then you really can't say this is the most recent activity that is happening. You're averaging at 100 bars. But the last 4 candles of every market is the most recent activity. And that's why I use a setting of 4. Does it really change much from 4 to 5? Not really. My preference is 4. If you use 10, you're looking at something that happened too far away, or it's unnecessary to look at what happened an hour ago, for example. It's best to look at the most recent activity to tell you what can happen within the next 4 candles moving forward into the future. So right here, 3.5 points hasn't really changed much. If this begins to get slower and slower, then I understand that the relationship is the market's beginning to get slower, maybe getting tighter or channeling as well. I'm not a big binary options trader. I prefer to trade the futures and to go long or short without the decay of options. You got it, Dean. All right, Dave. Forex, you can trade it on Forex, but you have to use a larger time frame than 1 minute because there's a spread. So as long as the spread makes it worth your while, you can put up a Forex chart or a currency chart. It works the same exact way. Nothing changes. And you just have to understand that so let me go to a euro here, euro currency. Okay, so going long here, you see here the 0.00175. What does that mean? Move the decimal place over 4 places to the right. So when you move the decimal place over 4 places to the right, you have 17 ticks. 1, 2, 3, 4, 17.5 or 17 ticks. So the rules are exactly the same. We're dictating our entries off of price action. The ATR tells us the same thing, 17 ticks. On this candle will be 15 ticks, and this candle will be 14 ticks, and this candle is 14 ticks. All right, Kevin's good. Mr. Kim, fixed. All right, glad to hear that on the ATR. All right, Andy, you got it. Let's take a look here at the E-mini. So strength trade to go short, maybe a pullback or a strength trade here in the future. So all trades based on the Atlas line are looking to go short. And if it happens to start to rally back up, you're going to get a long. I don't use volume, Kevin. I just use the ATR, which in essence, it's an idea of volume, but it's not volume based, it's range based. Yes, same rule, range bound markets, nothing changes. Okay, so stop loss, right? Brad wants to know about the stop. Great question. Brad, if you ever look at the videos I have out there, explain that protecting yourself with more than one stop is very important. And when you look at trading, typically you have a stop, which is the maximum amount you're ready to lose, and a profit target. And you have nothing else in between to help you exit the trade if the trade is not working in your favor, or if you have some other proof that the market isn't going in the direction that you want. So I think, and I teach this in the classes, in part of the programs, where you have to protect yourself completely with either a catastrophic stop plus some type of proof, a prove it stop, plus a time-based stop. Therefore, whichever stop occurs first, you want to exit. And that's very important to understand, because waiting for your stop to be hit, just waiting for it for the price stop to get hit, you're just waiting for it to happen. So here's what I suggest. When you look at this short here that occurred this morning at 20.8075 on the Atlas line, my expectation, we already know, is about 3.5 points, because that's what the average true range is showing us. And typically, this doesn't fail you. You can never go wrong with using the ATR. Even if you want to be more conservative and take 3 points instead of 3.5 or 3.25 or 2, you know that the conditions exist to reach that. But as far as a stop, my stop is going to be double the ATR up to 5 points on the E-mini S&P. So 5 points is what I call the catastrophic stop. Catastrophic stop. Catastrophic. That means that if I enter short and right away the news or something positive in the world occurs and everybody buys, the maximum that I'm going to risk is going to be, and every condition is different, so every trade is different, I'm going to double this value, maximum of 5 points. So in this case, 5 points. But what else can I use to exit the trade if my profit target of 3.5 points isn't reached? That's where you have the other stops, whichever happens first, which is time-based, and prove it stop. So a prove it stop tells me that a close on the opposite side of the Atlas line, I should be exiting the trade. I shouldn't be in this trade any longer, because I have proof the market's going on the opposite side, or closing on the opposite side. Time-based stop tells me that 4 candles after I enter, 1, 2, 3, 4 is enough time for me to make that target, and wherever the price happens to be at the close of the fourth candle, 1, 2, 3, 4 here, if that 3.5 points was not achieved, you close out the trade. It could be a winning trade, it could be a losing trade, it could be a break-even trade, but you're out of the trade, because the longer you hold on to a trade, the worse, and it's not going in your favor, or it's not working as you intended, the worse off you are. The results diminish dramatically because you want an instant reaction to why you entered. So you entered for a reason. Let's see it happen immediately. Same thing with the strength trade. It's an exact target for the strength trade of 1 point, or a time-based stop and a pivotal stop. So the stops for the setups are different, but you just don't have one stop. You have a culmination of stops, whichever happens first. So the good thing about the catastrophic stop is that you're going to be very happy to have it if there's an earthquake or something in the world happens which is not a scheduled news event and the market jumps. You're going to be lucky that you have that stop, because who knows, the market may go 10, 20 points in a matter of minutes. So that's an important factor to have that stop. On the other hand, you don't want to have a stop that's so tight that it's going to knock you out of the trade just on the randomness of the market moving up or down. Remember, I know the conditions. 3.5 points is what the market could move up or down from this candle, from this candle, from this candle even. 3.5 points, because we're still there, 3.5 points. So if your stop is smaller than the 3.5 points, the current conditions, just the randomness will knock you out. And that is a problem. And so the catastrophic stop, you're going to be happy to have it if something happens in the world. And the other good thing about this, it's very rarely hit. Very rarely will you get a catastrophic stop on a normal market condition. It's just in case of a catastrophe. What you're going to get instead is either the target, a prove it stop, which is a smaller stop, and a time-based stop, which could be a winner or a loser. Okay? Good question though, Brad. Let me know if that makes sense. Prove it stop is a close on the opposite side of the Atlas line. So if the market closes on the opposite side of the Atlas line after you enter, that's a prove it stop. So the stops, if you're asking how do we place them on the dome, you can only place the catastrophic stop when you first enter, and then you have to monitor the trade for the time-based stop, and you have to monitor the trade for a prove it stop. So those are both done by managing the trade. It's only the catastrophic stop that you can put on your ATM strategy when you first enter. Okay? Yep. That's correct. So as soon as you enter, place that target, place that catastrophic stop. All right, Brad, let me know if you have any further questions, if that makes sense to you. Yeah, so on Forex, it has to be relationship to the market, right, Andy? So if you look at the Forex market, the euro, for example, sometimes trades a little bit stronger than the Emini SP. So 5 points is the same as saying 20 ticks. If you're looking at Forex, I would say 30 pips is more along the lines of what currency would be a catastrophic stop. I would be happy with the 30 ticks or 30 pips on a euro or an Australian dollar as a catastrophic stop. No, you don't take the trade for a news event in the same direction. The news trade is specifically only a counter trend or counter move off of the chaos if it was wrong. So it could go either way. If the news is positive, the market can rally big. Then we have the Atlas line, we have the blueprint, we have the at the open, all to tell us to go long or the strength and pullback trades. So it's not a problem to continue into the same trend. The problem, and I think where we have to be careful with, is not assuming that it's going to continue just because it was a positive news event or negative news event. And so anytime throughout the day, if it reverses, that's an opportunity. All right? All right, Brad, you got it. Okay, how else can you prepare for the day? All right, so the Atlas line is a proprietary method. I offer it on DayTradeToWin.com. You can purchase either a lifetime license, which is free updates, or a 6-month license as well. And the code is pretty complicated. It's not based off of moving averages or trend lines or Fibonacci's. And so it's a very unique indicator, which we use price action to allow us to go long or short. So it's not based off of any criteria that you may have already seen or used. It's completely unique. Preparing for the day, I look at news. I look at whether the market is slow or whether the market is volatile. And I know that with the ATR. But I'm going to take you on a different path now, because sometimes we can tell the type of day it's going to be in advance of the day. So in preparing, what I like to do is I like to look at, for example, let's go to a daily chart. I like to look at what happened. So let me just remove this here. I like to look at what happened yesterday, or what happened 2 or 3 days ago. And you may ask, why am I looking at yesterday or 2 or 3 days ago when you want to interpret what the market is doing? Well, when you look at the market moving up or down, sometimes the market moves up or down in these large candles, and sometimes the market moves up or down in these small candles. But many times, the candles being up or down have nothing to do with how the day is going to plot. So you have to think about every day having no bias in direction. So no bias in the direction for the day. Right? So every day I prepare myself by not having a direction. Instead, what I want to do is I want to look at whether or not the market yesterday was a tight range day or if it was a large range day. And I'll tell you why. The days that you see plotting on the chart, what they do is they occur consecutively in the same fashion. You're going to see groupings and clumpings of days that are very similar. Remember, no bias in the direction. That's very important to understand, because just because today was an up day doesn't mean that tomorrow is going to be an up day, and vice versa. Just because today was a down day doesn't mean tomorrow is going to be a down day. So take the bias and the direction out of the equation. Instead, take a look at how you have a grouping of days that are all at 18, 16, very tight range on the average true range. And then take a look at a grouping of days that are very large, usually 4, 5 in a row. So this is a very common characteristic for every market, that you have a grouping of days that are slow, maybe channeling, maybe whipsawing, a lot of dojis, and then you have a grouping of days that are very large. Now those large range days are typically trending days. So which I'm going back here to thinking about what kind of day are we going to have? The type of day that we're going to have sometimes can be predicted based on what happened yesterday or a grouping of 2 or 3 days in a row, but don't have a direction in mind. The direction is taken care of by the setups, whether it be the Atlas line or the blueprint or the trade scalper or the ATO or the power price action method. So the trade setups themselves we need to hone in on, but the type of day I can predict. So if you look at all of these examples, and I'm going to show you here a very clear example. Here we have this. We have 1, 2, 3, 4, 5, 6, 7, 8 days. These 8 days had a range of about 30 points. So I'm just going to hone in on these 8 days here. So if you look at the ATR, 30 points, 35 points, it's pretty big numbers. And when you see this, you also realize that this candle was a trending day up, and this candle was a trending day down. So you hear the guy on the radio, and he says, you know, the market rallied big today because Apple had a new product, a new iWatch, or there's oil that the price is going down and people are happy, whatever, news, it doesn't matter. The very next day, the same guy on the TV says, and the market gave back all its gains and went down 200 Dow points or 30 E-mini or 30 S&P points. But he doesn't say to you that both days were a trending day. He just says that one day was up, one day was down. And this is common to see typical days that have the same range, right? Here, all these days have the same range pretty much, and they're all trending days, but no bias in direction. The direction is taken care of by the setups themselves. Am I going long? Why am I going long? Here's the reason. Maybe it's the ABC method. Maybe it's the news method I showed you. Maybe it's the Atlas line. Maybe it's the power price action. It doesn't matter. It just matters that I can anticipate a trend. This day here looks like it trended up and came roaring back down. Trend. This candle red, this candle green. But they're all days with large moves, which you can take advantage of. I'm going to go back here and look at this. But I don't know if these days here with an ATR, meaning the day, only had 10, between 8 and 10, maybe 13 points in range. Even maybe all this here. You see how day after day, it's exactly the same type of day. Tight, doji, flip-flop, back and forth. You can't trade this day exactly the same way you would on a trending day. You're looking for support and resistance. You're looking for channel. You're looking for bounces, the Atlas line bounce. You're not looking for this big runs. Can you trail a stop? No. Can't trail a stop on these days because as soon as you try to trail a stop, you get knocked out with a trailing stop reversing. Can you trail a stop on these days? Absolutely. So again, prepare yourself for the day. Let's see what happens today on Friday, the 17th, to tell us what kind of day we'll have on Monday. If today was a huge trending day, Monday, not that it's a guarantee, but look for another large range trending day. It could go up or down. So direction, not an issue. It's just the type of day that we can anticipate. And that's how I look at the market every single day. So you see here that we're at about 15 points here so far. On Monday, I probably will assume another day very similar to what you see here. 15-point range, not really a big trend, kind of a up and down move. Definitely not like this. Definitely not like this. But also not a tight range day like you've seen, like these guys here. All right, questions on that? It works the same way on every market. Groupings or clumpings of days. Look at this here. You have one up day, one down day. You have one up day, one down day. They're all the same range. The ATR is at 30 points, just like it was here. Well, we're looking at taking a long or short position based on the setups. It's only the interpretation of the type of day it's going to be. On a trending day, you have much more opportunity to trail a stop and to hold a trade. On a day that's very tight, like all of this here, back-to-back, small, tight range, it's not so much that it's trading the channel, and it's not so much the direction. It's that you have to take small targets because the market is slow. It doesn't continue. It just goes up. I mean, with an ATR of just 10 points, if you're lucky to get 2 or 3 points, if that, out of a day like this with such a tight range. 2 or 3 points on a day like this with the ATR 20 is nothing. Go for 5. You don't have to go for just two or 1. On this day, I know that it's not possible to take 10 points or 5 points. It's just not possible. And so you are dictating in advance the type of day based on what happened yesterday, okay? Yes, great question. Brad says, when is the grouping going to change? The cycle, right, Brad? So Brad asks a very unique question, which says, how do you know when the cycle is going to change, or how do you know when the market will just be a trend and the last, let's say, 10 days were all very tight? When you look at these days, you're going to see that the average true range here, let me just expand this here, and I'm going to crunch this because it's going to make more sense if I crunch this up. Do you see the cycle? And remember, cycles are important, but not the way many traders look at them. The cycle is always, when it comes to how the markets act and react, they get volatile and then they get tight or channel bound. They get volatile and they get channel bound or tight. If you know that, you don't really know, you can't say it's every 3 days or every 4 days. You can't say that. But what you can say is that if you look at this is increasing, the volatility is increasing, and it's increasing consecutively. So if the volatility is increasing, Brett, on this ATR, you know that each and every day we're getting the same volatility because the ATR is dropping off the last candle and adding on the new one, dropping off the last candle and adding the new completed candle. So you know that every day is getting volatile, which means the range of these candles are increasing, which dictates a grouping of large range trending days. You with me so far? Now, on the other hand, when the ATR begins to get smaller day by day, this is also the opposite indication that the volatility that you saw of the last 10 days is now changing, and we're getting the candles now moving forward are getting smaller in their range, which is obviously changing the way the ATR is displaying. I can no longer think of 30 points as a target. I can only think of maybe 20, and then 15, and then 10. And as the ATR rises and falls, this is telling me that the market is getting slower and slower. This is telling me that we're increasing. And so this is a grouping. This is a grouping. And so is this is a grouping. So it helps you understand the cycle if you look at the increase or decrease. So now my next question I have for you is, here we are today. And if you look at, Brad, or anyone can answer, if you look at the ATR, what can you surmise for Monday? Can you surmise that the day is going to be a large trending day automatically? Or can you probably agree that we're going to have a day that's going to be not more than 14 or 13? Because remember, look at this is getting smaller and smaller. These candles are getting tighter and tighter and tighter because it's dropping off this candle and adding on this one. It's dropping off this candle and adding on this one. And every subsequent candle is getting smaller. So now you know that the cycle will only change if you see the ATR begin to rise. You know that you're going to have larger and larger days consecutively occurring. So here, look how slow this is. Here at 10 points. This is the equivalent here. 10 points. Compared to 30, it's 3 times as large at 30 or 40 points than it is here at 10 to 15 points. 3 times the distance, which means more profit, trend, hold on to a trade. These days trend. These days do not. Brad, do you have a follow-up question for me? And let me know if that makes sense. I can assume a slower day on Monday until it starts to rise, and every candle or every day, which represents a candle, is getting larger, which then allows me to understand, okay, we're at 20 points on the day. 25 is actually normal. So 25 points is a normal S&P 500 range. I'm going to say it again. 25 points, normal. Above 25, expect trends. Below 25, expect whipsaw, channel, slow. 10, so I'm going to shrink this up here, and I'm going to tell you exactly, I'm going to add, let's say, 600 days to this. I'm going to give you an exact idea of what I'm referring to. If I shrink this, I know right away what's normal, what's an extreme, and what's slow by these values. So I mentioned to you 10 points slow. Each time the market hits on 10 points on the ATR, you have chop, channel, whipsaw, channel surf, trade differently, support resistance, not breakouts. When the market is at 35, 30, you can see that these are extremes where the market trends. Big days, big trending days. Take a trade long, hold it for the day. Take a trade short, hold it for the day. Now, I'm not saying take 30 points, guys, okay? What I'm saying is look at the relationship. You can't expect 30 points on a day that can only barely move 10. You can expect a 10 or 20 point gain on a day that can make 30 or 40 points. The ATR is telling you that. Smack dab in the middle, between this and this, you have 25 points. 23, 24, 25. This is normal. And that's why I said a little while ago that when the market has an average true range above 25, you're definitely looking at a little bit more volatility. Trends are probably going to happen. Less, more channel, more whipsaw. I would say counter trend. A lot of the methods that I teach are counter trend methods based on manipulation. You have to adapt if you trade. And that's why everybody optimizes, right? You say, well, I'm going to use these two moving average crosses, and you optimize it, and this is the perfect value. Then the market changes, as you can see, and then you re-optimize it, and then changes again, and you re-optimize it. It doesn't work that way. Every time you optimize, you're just taking a sample data. What you're looking at here is something very precise to tell you when and what to expect. Again, on Monday, I don't see any change as far as big trending day. Obviously, it could happen, but there's no real reason for the market to change. Wait until it pushes above 25 points or 23, let's say. Then you can say we're going to have grouping of days that are all trend. I trade differently. Hey, Kamel. No, it's not. It's not, Brad. It doesn't mean if the ATR is slow that the direction is changing. It doesn't work like I guess an RSI or a cycle like that. It has nothing to do with that. It's just we could have a year of the market being slow and just every day slowly edging higher. So it doesn't mean the trend is changing. It has nothing to do with that. It's just tight days. Okay. Hey, India, how are you? All right, Mr. Kim. All right, good. So every day I look at, and remember, I'm looking at the Emini SP, guys. It's universal. Price action should be universal. All right. The other thing I want to show you here is expectations for the rest of the year. So let me just remove here everything, and let's take a look at some recent trades that I recommended everyone take. If you've seen the videos, I started them off in January telling you the super year to go long. And I think that having a bias every day is wrong because it can get you in trouble. my overall general consensus is that this year will continually move higher and higher, but the timing has to be right. So just to give you a little bit of review here of what I'm anticipating through April, May, June, July, all the way until the end of the year, I'm expecting, right? So it doesn't mean it's going to happen. I'm expecting the market to go higher. Now, you don't just buy it and hold it. Let's do it and time it correctly. When the market retraces 4 or 5 days, 3, 4, 5 days, a nice pullback retracement, wait until the market reaches and breaks the highs by 2 to 3 points to go long. It hasn't done it here or here. That's one method, just like it did here. As soon as it breaks by 2 points, you're long, and away it went. The other method, which may be a little bit more conservative and gets you in quicker, is to look at going long once it moves beyond by 2 or 3 points again, 50% of the highest high and where it stopped. So I put out in the blog and in these webinars exact entries where to go long. And I know that many people went long because I get a ton of email thanking me for these long entries. 2072, 2073, long. What can you expect? A nice 28-point move. Brad, is that 28 points above 25 or 24, 23, indicating trend? Absolutely. So I can expect 28 points as a profit target, 74, 2074, 2100. Profit target. Now the market pulled back again and starts its new climb back up. Now ideally, before you take this a second time, which it worked a second time to go long again, ideally what you want to see is a new high first, then the retracement, and then wherever it stops, wherever the high, 3 points above, ATR should be above 24, 25, you're long, it's going to go and test that. So I expect, not that it's a guarantee, but I expect throughout the year we're going to have 3 or 4 more of these. And if you don't believe me, take a look at this high, nice pullback, you're long. Away it went. Here's another one. Nice retracement. You would think that this market would never turn around. The sky is falling. You're long, tested those highs. I have a couple of videos out, webinars, which really detail this method. And not that you can do this every single year. It's only on years with super year, and it's only on years that have a January effect. And so I teach the January effect. It's on the webinars. You can look it up on what the January effect is all about, this being a super year. Okay. JC, there was a trade here on the Atlas line. I'm not sure if you saw it at 20.8075. Some of you took it to go short. This is also a blueprint over here to go long. Jafar and Jason, those of you guys in the mentorship, those of you who have the power price action, this was a long trade here as well. And this candle in about a minute is going to be short. So this is going to be a short trade. It's a pretty big distance, but that's a short trade. You guys agree? Those of you who have the Atlas line? You guys know what I'm talking about? You can see a little bit of strength here. It's a pretty big pivotal stop, but this is going to trigger. And that's why price action is what I use to trade, and not just indicators crossing or above the zero, below the zero, or Fibonacci's. Mr. Kim, yeah, sure. So Fibonacci's are not something that I use, but I use the tool to help me understand. I'm sorry, where is it here? Fibonacci retracements. I use this tool. Well, there's the strength. See the strength trade? 2075, 50, 2075 quarter is the strength trade on the Atlas line to go short. Everyone who has the Atlas line has this trade. The only problem, there's a big pivotal stop here. 75 to 80, that's pretty big. That's the cautionary aspect of looking at overbought, oversold, over exhausted, right? So you have to know what that all means too, right? All right, so here are my settings. 0, 50, 100. You're looking at 0, 100, and 50. Remember to right-click here in this area, in this gray area, click Manage Templates, and just save over to default. I unchecked all the Fibonacci values everybody else is using, because I don't think they work. They work sometimes. It's all hit or miss. But I only use this tool for the 50%, which is very precise, because I like exact numbers. Mr. Kim, you okay with that? All right, Brian? All right, any other questions here? Jennifer, on on April 22nd, Paul, the class starts. You have already the first course, because I provide the At the Open, so you should have already the At the Open course. I offer it when you first put your deposit for the mentorship. So I know you have that, right? The At the Open method and the software. So I know you have that for the first class. You're in good shape, so you don't need anything. So just come to the room on April 22nd. We'll start off with the ATO, and you've read the course. I can't really go into too much detail here with the ATO, and I know that Chad set you up with it, so let's take a look at the At the Open. It's the first course that we learn for the mentorship program, and so yeah, so that's exactly, you're right. So it's 2076 quarter to go short, right there. And so this is the Atlas line, and this is the At the Open. So you're in good shape. Just show up on April 22nd. If you can't make every class, remember it's recorded for you. Right? I know that you have a day job, so if you can't make every class, Paul, don't worry. It's recorded for you. And then you get the next course every week for 8 weeks. All right? And you're all set up, right? Because Chad set you up. That's the short. And the same thing. This is 3.5 points, 2076 quarter to 2073, 2072.50. That's your target. 3.5, 3.25 points. All right, very good. But I wouldn't, Paul, I wouldn't start trading live. I know that you took this trade this morning. I got your email, but before we start, right? Because there's so much I have to teach you. I have to teach you the filtering. I have to teach you the roadmap. I have to teach you. There's so much I have to go into that. Don't trade live. I don't want you to lose. I don't want you to lose any money. All right, just follow it, learn it. We're gonna put it all together, okay? Just go to or email us, Mr. Kim, and go to DayTradeToWin.com, and you can look at. Yeah, it's recorded, Sam. Don't worry. It'll be on the blog. Okay. Let me see if I can find here the DayTradeToWin. I have a couple of monitors up here, and let's take a quick look here. I'll show you exactly where to go, and you can download all the pricing and the details. Here it is. And if you just go to DayTradeToWin.com here, This is the home page, and you go to private mentorship, and over here it gives you all the details, and then over here it has here your first name, last name, and when you click that, you get an automatic link to download the details. And you can always email us. I'll send it to you anyway. It doesn't matter. It's a PDF, which is this here. Okay. It gives you the pricing, gives you what you learn week by week, right? So week 1, week 2, week 3, week 4. All right, so just look at it. Email me, call me if you have any questions. I still have room available. Usually these classes get filled up. They're small classes, and it's all inclusive. It's just one price, discounted price for all the courses and all the methods. Free setup. I include NinjaTrader with live data, so you don't have to buy it or you don't have to get a broker. It's all inclusive. All right, guys, I got to run. Jason, see you Tuesday. You got it, Jason. All right, Jafar. I'll see you in class. You got it, Peter. Anyone has any questions on anything that I covered today? I wish I could cover more stuff, and maybe in the following webinars I'll teach you trailing stops and all that good stuff. So there's a lot still to learn, and hopefully you guys can take advantage of some of the programs I offer. You got it, guys. Take care, everyone.